Most homeowners think they have to sell their home before they can buy their next one. And honestly, that used to make sense. But in today's market, doing it that way is actually the thing that's holding you back. Today, I'm going to show you exactly how clients here at Lancaster are buying their next home first, before they've sold, without having to take on unnecessary risk and without feeling like they're gambling with their mortgage payments. This is a real strategy and it has a name. And once you understand it, you're going to wonder why no one explained it to you sooner. Here's what I hear from almost every homeowner I talk to in Lancaster. They want to make a move, they've outgrown their current place, or they want to upgrade, or even potentially thinking of relocating or downsizing. Whatever the reason, they are ready to make that move. But then when they start running the numbers, the math in their head, it goes a little something like this. What happens if I buy a new house, and what happens if my current one doesn't sell fast enough? What if I end up paying for two mortgages? And what if I can't even qualify whilst I still own this one? And so they wait, they don't move, or they put offers in with contingencies. And basically that just says, I'll buy your house, but only if everything goes perfect first on my end. That fear is what causes people to either make weak offers or settle for a home that wasn't really what they wanted, or not even win the home at all. I get it. These are real concerns, and I'm not just dismissing them. But fear without a strategy just costs you the home that you want and money in the long run. The traditional approach looks something like this. You sell your home first and then you go and buy. And look, it works. People do it all the time. But here's what actually happens in practice, especially in a hot market like Lancaster. You're either going to have to rent a place in between, which means you're moving twice, paying rent or living out of boxes, and the feeling of pressure to buy fast becomes more because you've got the clock running. Or you try to write a contingent offer, meaning you make an offer on a new home, but it's dependent on you selling your current home first. And in Lancaster right now, with inventory still tight and sellers getting multiple offers, a contingent one is one of the weakest things you can bring to the table. Sellers want certainty. Contingencies introduce uncertainty. It's as simple as that. The traditional way does work, but it puts you at a disadvantage in a competitive market, and disadvantages are expensive. So here's the strategy I've been walking my clients through, and it's been immensely successful, and it comes in these 3 steps. Buy first, then sell, then recast. Let me break that down. Step number 1, you're going to buy your new home with a low down payment. We're talking 5% conventional loan, maybe as much as 10%. You move in, you're in the house, you don't need your current home to sell first. Step number 2, you sell your current home. Now with no contingencies on your end, no pressure, no living in a temporary accommodation, you can sell it the right way. And step number 3, you take the proceeds from the sale and you apply that directly to your new loan or your new mortgage. And this is the part that people don't know about. You recast. What a recast actually does. A recast is not a refinance. I want to be clear about that because people confuse them often. When you refinance, what you're doing is you're getting a brand new loan, a new interest rate, a new closing date, new closing costs, and new paperwork. A recast keeps you on the exact same loan, the same interest, the same terms. The only thing that changes is that after you apply a lump sum to the principal, the lender is going to recalculate your monthly payment based on the lower balance. So in summary, same loan, lower payment, almost no fees, and no additional underwriting. So yes, temporarily after you buy that new home, you are going to be carrying a higher monthly payment. That is the trade-off, but it's only temporary. Now, I want to be honest with you. This strategy is not for everyone. It works best for homeowners who've built up real equity in their current home, people with stable income who can qualify to carry both mortgages at the same time, and buyers who are in the mid to higher price range, typically upgrading, relocating, or moving their family into a home that they've always wanted. If it sounds like you, then it's worth a real conversation. If you're a first-time home buyer or you're working with minimal equity, then this probably isn't going to be your play right now. And I'd rather be straight with you than waste your time trying to go through options that aren't going to make sense. Let me give you a real life example. I was working with a couple, they just had a new child, they'd outgrown their original property, and they were also looking at maybe moving to a different school district. They had a decent amount of equity in their home, let's say around 100,000 just for easy numbers sake. And what they wanted to do is they wanted to move into this new area. The property they were looking to purchase was around $600,000. They had enough money saved up for a 5% down payment. We did also manage to negotiate a little bit of seller help from the seller of that property. And all in all, we were able to cover their 5% down payment and their closing costs. When we went under agreement, we set the settlement date for about 30 days out. And then what we did was we had the strategy of how to get their home on the market the quickest. We set the settlement date for the 2nd of June. And although you technically pay days interest for the rest of the month, mentally it feels a little bit better because what happens is if you settle on the 2nd of June, your first payment isn't going to be until the 1st of August. Their home was in pretty good condition and showed very well anyway. So in this particular situation, once we knew we were under contract, we tidied up the property, we got the professional listing photos done, we did the video tour, we did all our marketing. And then what we did was the owners went away for the weekend. We priced the home strategically to get a lot of interest. We had 2 open houses on the Saturday and the Sunday, got lots of interest, and we actually ended up getting 3 offers. We had an offer ready for them, accepted in the 3rd week of May, and that was going to close around the middle of June. The buyers then managed to purchase their new property on the 2nd of June, and we closed on their existing property, I think it was around the 3rd week of June. And after they made that first payment on the new property, they then recast $100,000 off the existing mortgage, which brought their payment down. By taking a $100,000 lump sum at the interest rate at the time, it reduced their payment by about $700 or $800. And of course, if you have more equity than that, speak to your loan officer. They'll be able to tell you exactly how much your payment would adjust by. Using this strategy, they got the house they actually wanted. They moved one time and their payment ended up being right where they needed it to be. That is exactly what the strategy is designed to do. Now, that said, it all sounds well and good. However, there are some risks, and I'd rather be upfront with you about them as well. The first one is that you will have a temporarily higher monthly payment, and that's the math. You need to be able to handle paying both properties, even if it's for a short period of time. Typically, if you close on the 2nd of the month, your payment won't be until not the next month, but the following month. So if you close on the 2nd of June, your first payment would be August 1st. You have to qualify to carry both home loans simultaneously, and not every buyer is in a position to do that. The lender needs to confirm you can before you move forward. Timing. If your current home takes significantly longer to sell than expected, that bridge gets longer, it costs you more money. So realistically, you want to read your local market before you commit to it. You're going to want to have a very strong upfront conversation with your agent to make sure that the pricing is on point. You may want to try and increase that listing price by $5,000 or $10,000. However, if that delays the sale of your home by 30 days, it's going to end up costing you more money in the long run. And here's why it matters so much in today's market specifically. Inventory in Lancaster is still very tight. There are buyers competing for the same homes, and the good homes are going with multiple offers. As soon as there's multiple offers, people are choosing to not necessarily go with just the highest price, they're going for the most certain offer, which is why they don't particularly like contingencies or contingent on sales. A non-contingent buyer who can close, that's an extremely attractive offer in this market compared to someone who doesn't necessarily have the most amount of money or is contingent on the sale of their home. When you've already secured your next home, you are then selling with no strings attached. You can then show up to negotiations from a position of strength and not desperation, assuming you've priced it right. If any of this sounds like it could apply to your situation, the first step is just running your actual numbers. Not hypothetical, not a spreadsheet you build at midnight, no talking to ChatGPT in the middle of the day. Your numbers, your equity, your home with someone who knows the market and can tell you honestly whether this makes sense for you. This is a conversation I have with people every single week, and it costs you nothing to have the conversation, and you'll walk away knowing exactly where you stand. And if you want to understand the recasting process more deeply before you take any next steps, I've got another video that breaks it down from start to finish, so watch that one next.